This is Nightly Business Report with Bill Griffith and Sue Herrera.
New high. The S&P closes at a level never seen before as bond yields fall below a key level and investors wonder what's next.
Hot home prices. Mortgage rates are falling, but that may not be in the best interest of buyers.
New perk. What one company is doing to help employees save for retirement and pay down student debt at the same time. Those stories and much more tonight on Nightly Business Report for Thursday, June 20th.
And we do bid you a good evening, everybody, and welcome. There were a number of notable movements in the markets today. On Wall Street, for example, as you heard, the S&P closed at a new high with investors cheering the idea that the Federal Reserve might cut interest rates next month. That seems to be how the market interpreted the central bank's pledge to sustain the expansion, which we told you about yesterday. Oil prices were up more than 5% on geopolitical concerns, and oil stocks followed suit. And finally, interest rates continued lower, with the yield on the 10-year Treasury dipping below 2% for a time today to a 3-year low. At the close, the Dow rose 249 points. We're at 26,753. The Nasdaq added 64, and the S&P 500 was up 27 at that record. Bob Pisani was following the action from the New York Stock Exchange.
What's behind the rally? There's a lot of euphoria out there. Euphoria about the Federal Reserve and central bank policy and the prospects of lower interest rates, and euphoria about U.S.-China trade talks. Energy led the gains today. Crude oil spiked almost 6% after Iran shot down a U.S. military surveillance drone in international airspace in what U.S. officials called an unprovoked attack. This, of course, comes amid mounting tensions between Washington and Tehran and amid other recent attacks on oil tankers in the Persian Gulf. The markets took a brief dip midday on comments from President Donald Trump saying Iran made a big mistake, quote unquote, and hinting that the U.S. could be considering a strike against Iran. But it bounced back soon after when the president appeared to speculate that perhaps the drone was shot down in error after all. Trade also played a part in today's moves. Stocks moved higher on a headline coming from the South China Morning Post that China and U.S. negotiating teams may be meeting as early as Tuesday next week before the big G20 summit. So what's missing from this rally? We're lacking some fundamental firepower. Just look at Carnival Cruise Line today, cutting its full-year forecast because of weaker European bookings and more travel restrictions. Carnival closed down 8% and took down rival cruise line operators Norwegian and Royal Caribbean along with it. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So with parts of the market at a record, what is next for stocks? Joining us to discuss this is Brian Levitt. He is Senior Director of Investment Strategy at Invesco. Welcome, Brian. Nice to have you here tonight.
Thank you. Nice to be back.
And you make the point that we are still in a long-term bull market. There's more to go. Why do you feel that way?
Yeah, I mean, investors need to get used to the fact that this is a slow growth world without a lot of inflation. So what that means is even though this cycle's been going on for a long time, we haven't built a lot of excesses in the economy. We're not seeing the inflation that brings forward Fed interest rate hikes. And it's very rare for cycles to end without a series of interest rate hikes. The reason why the markets have been responding the way they have in recent days is because the Fed's backed down off their tightening stance. And you know, with valuations where they are and the global economy okay, this could go on a lot longer than people suspect.
And in fact, you are among those who feel the Fed will cut rates maybe a couple times this year before the end of the year. And I'm curious, you know, Fed Chair Jerome Powell reminded everybody yesterday of the Fed's dual mandate of maximum employment and stable prices. What is it that's calling for a rate cut right now, do you think?
What's calling for a rate hike right now is that inflation. A rate cut is inflation expectations have fallen meaningfully in the United States and around the world. And so, you know, if you think through the last number of years, Fed tried to raise rates in 2015. Well, they did. They had to back off of it. They did it multiple times in 2018, slowed the economy, and now they have to back off of it. So every time the Fed tries to step in with a different policy stance, i.e. tighter policy, the markets react, yields go down, borrowing costs go up, the economy slows, markets go down, and the Fed backs off again. And so this is no different than what we saw in early 2016. And the Fed's rightfully doing it. Inflation expectations are simply too low in the United States.
We do have some headline risk, though, do we not? We have an upcoming G20 summit. We don't have a trade deal with China. And now we have renewed tensions with Iran.
Well, we always have headline risk. I mean, if we're going to wait till there's absolute certainty to invest, we'll never invest. You're right. The trade policy is disconcerting. And, the big risk with trade is that it'll lead to a flight to quality, strengthen the U.S. dollar, and slow down the U.S. economy again. So that is a risk. But the reality is what that means is the Federal Reserve is going to lower interest rates and stay easier for longer. So, 3 years ago, investors would have been talking about Brexit. What did Brexit mean? Brexit meant easier policy around the world and markets that continue to go higher. So if we get a bad outcome between the U.S. and China, that's not good from a macro perspective. But what's more important is what does it mean for investors? I suspect you may have a bout of volatility around it, but the Fed will respond and markets should likely go higher.
On that note, Brian, thanks so much. Brian Levitt with Invesco.
Thank you.
As we mentioned earlier, investor optimism apparently is being driven by this hope that the Federal Reserve will lower its benchmark interest rate. But is it the right time to cut? Steve Leisman takes a look for us tonight.
A bullish stock market reaction to the Fed's announcement this week, suggesting a stock and bond market that are virtually certain the Fed will cut rates next month and even more beyond. There are reasons for the exuberance. 8 Fed officials forecast at least one cut, and 7 of them are forecasting 2. Fed Chair Jay Powell said the balance sheet runoff, that is the quantitative easing that it had been reversing, could end earlier. Powell also hinted at a possible full half-point cut instead of just a quarter. And that's the call of Morgan Stanley, which said in its Fed report, quote, a July rate cut of 50 basis points or half a point is coming. Downside risks from global growth and trade have dragged the Fed away from neutral. The Federal Market Committee will want to take an aggressive stance. But is the market too bullish? Rate cuts generally come with a weaker economy, and that could mean earnings disappointments. From the other side, there remains the possibility the cut never happens because the president strikes a trade deal with China and the economy turns out better than expected.
With the summit with Xi, I think it'll be a positive outcome. I think they both need a deal. They both need a success. I don't think the tariffs will go up on July 1. I think the employment report on July 5 will be fine. And I think that the second quarter GDP number will be fine.
And then there's the market level. Back in 1995, the Fed cut rates when, like today, stocks were at or near an all-time high. That worked out well as the economy and the Dow marched on for years to come. But it also cut rates near an all-time high in 2007. That ended poorly for both the economy and the stock market. So investors have to puzzle over whether the rate cut is coming, how much is coming, and if it does come, will it be enough for the economy? For Nightly Business Report, I'm Steve Leisman in Washington.
And low interest rates have certainly been good for dividend-paying stocks this year. They have been hot, and they could get even hotter if the Fed does, in fact, cut rates further. Joining us to talk about that, David Dietz. He's President, Chief Investment Strategist at Point View Wealth Management, and a big fan of dividend-paying companies, too, at the same time, right?
Absolutely. Yeah.
Well, I was going to say, but are we taking more risk? Certainly you get a better yield from a lot of these stocks than you would from treasuries, for example, right now. But are you taking more risk because of the high prices right now?
Well, certainly. I mean, now that the interest rates have fallen so much because of anticipations of Fed rate cuts, dividend stocks are looking more and more attractive as people who are traditionally in fixed income are now looking over their shoulders and looking at some of the better yielding stocks and saying, maybe this is where I can pick up some more yield. This is particularly true because credit bonds are also very tightly trading relative to treasuries.
Right.
What I like about dividend-paying stocks right now is that if interest rates continue to go lower, they just look that much more attractive. But look, we just hit an all-time high today, Bill. And so what happens if something doesn't work out, that there's a breakdown in trade negotiations, or the Fed doesn't cooperate, the market could retreat. Again, dividends give you some stability, some cushion, which gives you some protection on the downside.
But you're particular about what you like. So you say that you picked 3 or 4 stocks for us that would work in a low interest rate environment and perhaps a lower interest rate environment.
Well, we like healthcare stocks. You know, that's the other growth sector besides technology, but it's been held back due to all sorts of political concerns, Medicaid for all. So we're looking at some of the very best franchises out there, and lo and behold, they're paying some of the best yields. I would cite Pfizer, which is probably the bluest of all blue chips in pharma, internationally diversified, great R&D pipeline, but you've got a 3.4% dividend, and that dividend has grown over the last 5 years by about 8% a year. And I would also look at CVS. It's now very vertically integrated with its recent merger of Aetna, 10,000 pharmacy stores across the country, and it's yielding close to 4%, and that dividend has increased about over 20% per year on average for the last decade.
We also showed you like Exxon and Wells Fargo in the dividend-paying category, but they're not all created equal. There are at least a couple that you're not looking at right now because they might be too expensive.
To characterize it quite broadly, I think you have to be very careful with dividend-paying stocks because the only thing worse than a non-dividend-paying stock is a high dividend-paying stock where they cut it and then look up below. I'm looking at AT&T right here, which is yielding about 6.5%, significantly more than Verizon. So you have to scratch your head and say, why? Well, they've diversified heavily into content as well as their traditional telecom. It's hard to see how those synergies are working. They have a tremendous debt load. Verizon's staying focused so that if there's a hiccup in perhaps the content business, perhaps the satellite business, and all of a sudden they have trouble with the debt, they may have to cut the dividend, look up below. And of course, retailers, unless they have a great strategy against the internet competition, their dividends are also at risk.
And Bed Bath & Beyond is the one that you're looking at most closely there as well.
Absolutely.
David Dietz with Point View Wealth Management. Always good to see you. Thanks for stopping by.
Thank you, Bill.
You bet.
Well, lower interest rates generally translate into lower mortgage rates, which is what happened this week. And while that may seem like good news for the housing market, it's not all that great for buyers. Diana Olick explains.
Falling mortgage rates are helping more house hunters make the math work on a monthly payment. The average rate on the 30-year fixed has fallen steadily since April, lowering that payment on every home for sale. But lower rates are also bringing out more buyers, fueling competition yet again, just as fast-rising home prices were finally slowing down.
The recent drop in the 30-year mortgage rate gives us a little bit of a reason to believe that this slowdown won't last very long.
In fact, price gains are suddenly widening again. The median price of a home sold in May rose 3.6% annually, the largest jump in 7 months, according to Redfin. Prices are gaining the most steam on the low end of the market where supply is leanest. Builders are of little help there. Housing starts dropped over 12% annually in May, and permits were lower as well. What the builders are putting up is largely on the higher end as they battle high costs for land, labor, and regulatory compliance.
The only issue is that as rates go down, you still have low inventory, and that's going to limit sales. So prices are going to go up, sales will not be as strong.
The supply of existing homes for sale was gaining, but is now shrinking again, especially for affordable homes. Part of that is due to increased investor demand. At the end of last year, investors made up over 11% of home purchases, the highest rate since CoreLogic began tracking in 1999. The vast majority of those buying are small investors coming in with cash. For regular buyers, the sting of higher prices and the increasing competition from all-cash investors are both negating the benefit of lower mortgage rates and taking the heat out of what some thought might be a hot summer for housing. For Nightly Business Report, I'm Diana Olick in Washington.
To the economy now, the number of Americans filing for unemployment benefits is still clinging to its lowest levels in decades. Initial jobless claims fell by 6,000 last week. That was a bigger drop than expected. And the number of people already collecting unemployment benefits, known as continuing claims, that's near the lowest level since the early 1970s.
And a gauge of manufacturing activity in the Philadelphia area fell this month to its lowest level since February. The report cites a decline in prices for the drop, as well as a slide in new orders and shipments.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of Hershey tonight. They were downgraded to underweight from neutral at Piper Jaffray. The analyst cited the stock's valuation and its historically high premium compared to its peers. Price target $125. That stock fell a fraction to $137.64. Apple was initiated with a hold rating in new coverage at Deutsche Bank. The analyst cited a potential lull in the iPhone cycle ahead of the expected introduction of 5G phones next year. price target, $205. That stock closed just below that level at $199.46 today. And Tesla's price target was lowered sharply at Goldman Sachs down to $158. The analyst believes that volume estimates are high, and he sees the stock trending lower. Goldman's rating on Tesla does remain a sell. Shares fell 3% today to $219.62.
Still ahead, healthcare costs are expected to rise for companies, even as they put more programs in place to lower them. Issued a warning of sorts. CEO Tim Cook says that if the next round of proposed Chinese tariffs go into effect, they would reduce Apple's contributions to the U.S. economy and weigh on its global competitiveness. The threatened tariffs of up to 25% would impact nearly all of Apple's products, including the iPhone, the iPad, AirPods, and repair parts.
International tax law has been a focus of U.S. lawmakers for a while now. Remember, 2 years ago, Republican leaders in the House pushed to rewrite the code to prevent companies from shifting profits overseas. And today, two prominent Democratic senators proposed a new idea, one that they say will help American workers. Ilan Mui has details from Washington.
Democrats unveiled a new proposal today that would raise taxes on foreign profits to help unemployed workers here at home. The idea comes from two powerful senators, Ron Wyden, the top Democrat on the Finance Committee, and Chris Van Hollen, who sits on the Banking Committee. They argue that the current tax system actually encourages companies to build their factories overseas.
We want to take away incentives to move jobs overseas, make sure we incentivize employers here at home, and then incentivize them to hire Americans who want to work, but who are out of work.
To fix that, they call for closing those loopholes or creating a minimum tax on overseas earnings that would apply to every company. But not everyone believes there's a problem. Republicans overhauled the tax code last year in hopes of stopping companies from parking those profits overseas.
Combined with the reduction in the corporate tax rate and with the international provisions, my own view is that the incentives to invest in the United States have improved, certainly improved over the old tax code.
But the senator said making sure those companies pay their fair share could raise a lot of revenue, money that could go towards subsidizing jobs for America's long-term unemployed.
It's really an effort to get people back into the system, because these are individuals who, once you're out of work, it's harder and harder to get a job because employers look at your work history and it becomes a chronic problem that hurts the family and hurts the whole economy.
That prospect is generating interest from presidential candidates who are both embracing ambitious new policies and looking for ways to pay for them. Amy Klobuchar made tackling the international tax code part of her agenda for the first 100 days in office, and Joe Biden supported raising taxes on foreign earnings when he was vice president. So it's a good bet you'll hear a lot more about these issues on the campaign trail. For Nightly Business Report, I'm Ilan Mui in Washington.
Slack makes its Wall Street debut. That's where we begin tonight's market focus. The workplace communication software company began trading at an opening price of $38.50, well above the $26 reference price set by the New York Stock Exchange. Slack came public in a direct listing instead of the traditional IPO, and the CEO says it was the best route for his company.
I think there's a lot of investors who are used to a model where they get a small allocation, they wanted a big one in direct listing. At least they have the opportunity. One of the hopes for a company like us is that there's not too much volatility. And we are hoping that this model, where there's many sellers, many buyers, supply and demand, we reach a market clearing price a lot earlier.
Slack shares rose nearly 50% to $38.62. Darden Restaurants beat analyst earnings expectations but fell short in revenue and same-store sales growth because of less foot traffic to the company's top chain restaurant, Olive Garden. Darden also gave weak guidance, but the stock was up more than 1% to $118.67. Kroger reported better than expected quarterly earnings. The grocery store chain saw same-store sales come in flat, but digital sales rose. Kroger also affirmed its full-year guidance, but the shares fell more than 2% to $23.13.
Merck today held its first investor day in 5 years, and it laid out its strategic priorities to drive value. The key is to broaden its portfolio beyond its blockbuster drug Keytruda.
We're here to show today is that we have great opportunities to grow revenue beyond Keytruda with our vaccines, our animal health business, our hospitals and specialty business, the oncology pipeline beyond Keytruda. So we have those opportunities to drive revenue growth, margin expansion.
And Merck's shares fell a fraction today to $84.60. Walmart has agreed to pay more than $280 million to end a 7-year-long investigation into a global corruption probe. It settles charges that the retailer ignored evidence of internal corruption that helped fuel its overseas expansion. As part of that settlement, Walmart acknowledged wrongdoing. The stock rose a fraction today to $110.32.
Rising healthcare costs have been a major issue for corporate America for quite some time, and a new survey shows the headache isn't going anywhere anytime soon. Bertha Coombs has more.
Healthcare costs keep rising, and next year the growth is expected to accelerate. Private employer costs are expected to increase 6% in 2020, according to PwC's Health Research Institute, up from an average of 5.5% growth the last 3 years. One big driver, high-priced specialty drugs.
One of the reasons that we have the drug cost increasing is because there's a higher proportion of drugs that employers are buying are specialty drugs, and those tend to be more expensive than non-specialty drugs. So over time, that will increase the cost.
While specialty medications to treat complex conditions like hepatitis and cancer make up just 1/5 of all employee prescriptions, they account for more than 40% of overall drug spending. Over the last decade, employers dealt with the problem by making workers share more of the cost. But PwC says raising deductibles and copays isn't working.
Almost 1/3 of employees with high deductible health plans actually cannot afford their deductible. So that's a big wake-up call for employers.
Employers are now focused on tackling high prices head-on, pushing insurers and pharmacy benefit plans for better deals, and more large firms are contracting directly with medical providers to steer workers to the most cost-effective care.
They're looking at setting up their own primary care networks and primary care clinics on site to better take care of their employees at a lower cost. They're looking to help nudge their employees to lower cost sites of care.
What it means for workers, a reprieve on deductible increases, but expect narrower choices for care and more of that nudging to take preventive steps to fight chronic conditions and stay healthy. For Nightly Business Report, I'm Bertha Coombs.
And coming up, solving a catch-22, how one company is helping employees save for retirement while still facing high levels of student debt. As student debt levels continue to rise, some employees have been opting to pay that down instead of saving for retirement. But now some companies are offering a new perk that helps workers do both. Sharon Epperson is in Pleasanton, California for us tonight.
Recent grad Javier Humpal is building technology that could someday save heart transplant patients.
Each day is a new challenge. It's a very dynamic, complex setting, but it is very rewarding.
The 24-year-old biomedical engineer had 3 job offers coming out of grad school. He chose this one at Abbott, a global healthcare company. Not for the salary or medical benefits, but because it was the only one with a program that could help him save for retirement while paying off his student loans.
It was the main linchpin to why I accepted an offer.
Employees usually have to contribute part of their pay to their 401k plan in order to receive matching company funds. Abbott's Freedom to Save program gets rid of that requirement. As long as Humpal uses 2% of his salary to pay off his student debt, Abbott will make a 5% pre-tax contribution to his 401k. even though he's not putting in a dime. The money is fully vested in 2 years. Abbott executive Steve Fusell says the program pays for itself.
The cost to us is actually very minimal. There's actually a 5-to-1 payback because of our retained talent and avoiding of cost of turnover in this group.
Nationwide, 7 out of 10 recent grads have taken out student loans, graduating with an average debt of about $30,000. That's hurting their ability to save for retirement. Research shows that college grads with student loans only save about half as much as those without loans by the time they're 30. Some employers recognize how difficult this debt burden can be, and they're trying to help.
We're starting to see more and more employers offer this type of benefit because it carries a long-term monetary value for the employees.
According to the Society for Human Resource Management, 8% of employers offer student loan assistance. The largest include Aetna, Fidelity Investments, and PricewaterhouseCoopers. Right now, none except for Abbott help with retirement savings. However, next year, the insurance company Travelers plans to roll out a similar program.
It's a valuable benefit because people who are just beginning their careers don't have to make a trade-off between paying off their debt and saving for their future.
Humpal is taking the $150 he would have put in his 401k and adding it to his monthly loan payment. That's translating to big savings.
Initially, I had $60,000 in student loan debt. I will pay my loans 4 years faster, and I will save in $7,000 in principal loan interest.
For Nightly Business Report, I'm Sharon Epperson.
Here's another look at the day's final numbers from Wall Street. The Dow rose 249 points. The Nasdaq added 64, and the S&P 500 closed at a record. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening, everybody. See you tomorrow.